The market for platinum group metals is heading into 2026 with one of its most complex and consequential setups in years. After a third consecutive major deficit forecast for 2025, the World Platinum Investment Council now sees the possibility of a more balanced market next year, but only if a series of critical assumptions play out. Speaking to InvestorStream, Director of Research Ed Stirk unpacked the real drivers behind this tightness, the risks embedded in the forward outlook, and the structural trends that may reshape the market for years.
I think there's probably a couple of factors behind the kind of deficit for this year. Firstly, it's very constrained supply. So mine supply down 2% year on year. It's not a staggering change, but it would be difficult to see it move meaningfully in the other direction as well. Recycling supply we do have gradually improving, but given the price performance that we've had for the whole of the PGM complex since May, actually it's kind of surprising that we haven't seen a greater reaction from the recyclers. In fact, quarter on quarter, recycling volumes are down in the third quarter despite the higher prices. And you've kind of got to match that up with the demand picture.
According to Stirk, the core issue is simple. Supply continues to lag behind demand.
But fundamentally, demand is relatively robust from the automotive, jewellery and industrial side of the equation. Industrial is down a little bit this year. That's on a cyclical downturn in terms of glass capacity additions, which we expect to come back next year. But overall, demand is still looking fairly good. So it's just simply this ongoing mismatch between constrained supply and I'm not going to call demand staggeringly strong, but it's robust. It's broadly unchanged.
The real swing factor this year has been investment demand, particularly in the US. Trade tensions and tariff concerns prompted substantial metal onshoring, and while the WPIC's base case assumes these factors ease next year, Stirk cautions that there are clear risks to that assumption.
Looking to next year, we've actually got a base case forecast of the market being broadly in balance. That reflects an assumption that we see an easing of trade tensions. It also reflects an assumption that we see ETF profit taking. Now, just to kind of risk assess those two things for a minute, one of the unexpected side effects of the trade tensions this year has been that the US has built up a stockpile of critical minerals. And this isn't just platinum, it's across a number of other minerals, including copper and so on. And interestingly, the government hasn't had to fund that. It's been funded by private enterprise. And so in a weird way, maintaining trade tensions next year allows the US to sustain that stockpile at no cost to the public purse. Equally for ETFs, which at one point the platinum price was up almost, over $700 an ounce. We didn't see any net outflows from ETFs, no material net outflows, and we're actually still up year to date. So, looking ahead to next year, our base case assumptions is that those two situations change, but there are some risks to that outlook that I think I'd be a bit careful of, because if it doesn't happen, we sustain a deficit of about 300,000 ounces for next year.
On the demand side, the most significant structural strength is emerging from bar and coin investment, particularly in China, while underlying US demand is somewhat constrained by the high cost of fabrication caused by elevated lease rates. Stirk said investors were increasingly turning to platinum as the high gold price pushes them toward alternatives, a trend that is also supporting platinum jewellery, which continues to perform well in contrast to gold's price-driven consumer substitution.
But overall, I think bar and coin would be the area where we see the most consistent demand strength. And part of that is linked to the high gold price. The high gold price at the moment, and I don't see any reason for that to change given the geopolitical and macroeconomic factors, is causing investors to look for alternatives, and that includes platinum as well as silver and so on. It's also having an impact on the jewellery demand. So, we've actually seen pretty consistent strength in demand for platinum jewellery, and that's quite a contrast to gold, which has been struggling with consumers pivoting towards other lower cost options. In terms of the industrial complex, I think we are expecting a bit of a recovery in terms of glass capacity additions for next year, and depending upon the progress with renewable energy in the future, which is quite a big consumer of glass fibre, and glass fibre production uses platinum, then we could see some growth in that going forwards. But it's perhaps a little bit less. I've got a slightly lower confidence in that outlook than, say, for bar and coin.
For investors exploring supply-side opportunities, the environment is becoming more constructive, as the WPIC expects platinum to remain in deficit for the foreseeable future. And according to Stirk, the current dynamics could be supportive for greenfield PGM projects establishing new sources of supply.
On our numbers, we've got platinum remaining in a deficit for the foreseeable future. It's a little bit more nuanced for palladium and for rhodium, and that's really because it depends upon the pace of electrification of the global drivetrain. More than 80% of both those metals' end uses are in catalytic converters. As things stand at the moment, we are seeing a bit of a move to kind of soften the pace of that transition, which would be supportive of longer term demand for those metals.
These favourable dynamics open the door for budding producers like Southern Palladium. Amid the positive market sentiment in 2025, the Platinum Group Metals company continues to advance development at the world-class Bengwenyama mine in South Africa's Bushveld complex, known as the global home of PGMs. Bengwenyama already boasts a probable ore reserve of 6.29 million ounces, with robust grades above 6 grams per tonne of elements primarily comprising of platinum, palladium and rhodium. Following the delivery of a comprehensive pre-feasibility study which valued Bengwenyama at north of $1 billion and the recent completion of a $20 million placement, the company is now busy with mine planning as it targets intersections in the shallow portion of the UG2 reef, with expected depths as little as 50 metres to further de-risk near-term project development. With the receipt of Southern Palladium's mining right now expected imminently, all eyes are on the company in 2026 as it aims to become one of the only pure-play PGM investment opportunities on the ASX in a rising price environment. And Stirk remains somewhat bullish on the market environment going forward.
With prices where they are, there are a number of projects that potentially could stack up and attract investor interest to fund the construction process for them. And certainly in the future, we do have sustained demand for metals, which certainly in terms of platinum, look like they're going to be undersupplied. So, I think there is a fairly constructive environment out there.
For a company like Southern Palladium, a tightening market could be of some benefit, particularly as the production profile of Bengwenyama looks set to shape the supply side once it comes online. For investors, the implications are clear. With supply constrained, demand resilient and inventories lean, any slip in WPIC's assumptions could accelerate a renewed surge in platinum prices. 2026 may not just be a year of balance, it could be the start of a broader re-rating for producers positioned to capitalise on the tightening PGM market.